At least a dozen times a week, I'm asked by avid property investors why we shouldn't all be buying commercial property. Since the rental yield on a commercial property, at around 10%, is most often better than that on a residential property at between 3 and 6%, many wonder why we should not just all run out and buy one. Well, here are some things to know. You'll get a higher rate of return for the money spent, usually around 10%, as long as you have a tenant. A commercial property with a history of consistent tenancy or with a secure long-term tenant can be easier to sell than a residential property. Lease periods can last much longer, locking in a good tenant with 3 to 5 years the standard term, and the ultimate sale value of a commercial property is often linked to its return. So, for example, a property which attracts $40,000 a year in rent at a market capitalisation of 10% would be worth $400,000 if sold. Of course, the value will be affected if the rents drop. There are some negative features too, though. A commercial property is likely to attract small business owners, as larger businesses very often own their own property. As more than 80% of small businesses go broke in the first 5 years, there's a high chance of getting tenants who won't see out their lease. Often, in order to attract the tenant, the landlord must offer a range of incentives, which may include fit-out, rent-free periods, etc. This can severely eat into your return, especially where leases are for a shorter period. A commercial property has a markedly higher rate of vacancy, which can last for much longer periods of time. Commercial property is affected by both the tenancy market and the general state of the economy, as the tenant's business will suffer hardship when the economy is performing poorly. Therefore, in addition to the market risk, there's a specific risk with commercial property. The risk of investing in commercial property would be considered medium when compared to other non-property investment vehicles, and medium to high when compared to other property types. This means that when you buy a commercial property, you're taking more of a risk than you take when buying other property, in particular residential property. The decision to buy any commercial property must be based both on the potential of the property to satisfy successful investing criteria, as well as a consideration of your own personal risk profile.